All right. What up, YouTube? YouTube. You got the dog back in the house. Woof woof. You got, of course, not your guru in the sesh here. The exceptional pleb. Way too loud. And, yeah, we out here. October 24th, 2025. Holy shit, we're gonna have to say 2026 pretty soon. And, we've got the first little bit of data coming out here in 2 minutes, so I thought that might as well go live and just see the madness here. Market is thirsty for some data, and it comes in the form of a big one, the CPI. Not really, but um, it's, I mean, it's what Fed has been talking about for way too long. And just playing around with some settings here. Doop. All right. And yeah, data should be out any moment now, and we're gonna see it live here. And yeah, crazy kind of being here. Still out here in the set, and yeah, certainly would be nice to be able to view kind of multi markets here, just because you kind of want to see it from a multiple different angles. If we see the SOFR curve start rallying, probably see risk start rallying. Doesn't look like that's happening, and kind of looks like SOFR's selling off. Nice way to say that there. And then gold as well. If we see heightened rate cut bets, which that's not that right there, then we'll see. Oh, it's out. It's out. ZB getting crushed. SOFR caught a bid. SOFR caught a good bid there. That was quick. That was really quick. Wow.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound.
I can't believe that Bloomberg is just dropping the ball with their fucking ads.
In terms of where we are for the total month here, we're going to have to check out the overall numbers here, but let me give you a few before we check the market. Food prices.
Yeah, gold caught a nice bid on that.
Worried about only up 0.2 after being up 0.5 in the month of August. Energy prices in terms of gasoline up 4.1%. That added to inflation definitely. It was only up 1.9% the month before. And here's something good. Car prices. New vehicle prices up just 0.2%. We thought we might see a jump because of the new models coming in. Used car.
So they were expecting a hotter report than this. Hotter inflation report, 3%. And we saw this over here on the 15-minute. Unbelievable expansion there.
Mike, that is what we call the right kind of downside surprise on headline and on core. Headline inflation comes in at 0.3, the estimate in our survey 0.4. Core CPI month over month comes in at 0.2, the estimate in our survey 0.3. Off the back of that, push it through the bond market, 2-year, 10-year, 30-year bond yields declining as you might expect, particularly at the front end of the curve. We're down by 4 basis points to 345. Take the bond move, push it through foreign exchange. What have you got? Some dollar weakness, euro dollar up to 116.40. And ultimately, with that kind of yield move, equities up by 0.7% on the S&P.
Yeah, big rally.
Some big outperformance on small caps. Bramo up by 1.6%.
That was exactly where I went to, this idea of how much this is going to help some of the smaller and mid-sized companies that really have been more significantly affected by higher rates. This is a clear signal to the Fed that they can go for 25 basis points. My question is, how long before we start to see some
Look at
analysts
these
say,
dubs.
this means they can go 50 or something.
Dubs can come out. Yeah, 50 basis points cut right there.
And Mike, I'm sure you've got another take on the data, but I've got another question on the Federal Reserve, and if we can deal with that up front. I think for many people, this data this morning wasn't going to change whether the Fed will or won't go next Wednesday. Does it give them a little bit more space to guide beyond October when the chairman sits in that news conference and addresses you directly?
I don't think it really does, in the sense that we are flying blind right now in the month of October, and when they get to December, they may not have any October data, and who knows whether they'll have November data. So at that point, they're really not going to be sure of where we are with inflation, and they're certainly maybe not going to know
Knee-jerk reaction.
really
Talk
what
about a
is what
knee-jerk.
happens with
Holy
the labor
shit.
market. So I think you have to assume that December is going to be up in the air until at least we know when this shutdown ends and data starts coming back in again. Things we want to note here for you in terms of prices. Rent of shelter, we're talking about here the overall housing numbers that play into services, up by just 1.4%. No, I'm sorry, I'm reading the wrong one. By just 0.2, which is good news because shelter has been coming down. Owner's equivalent rent up just 0.1. I don't have the comparison, but that is the lowest in many, many, many months. And remember how last year we were always worried about when would housing come down. So as I mentioned, we're also seeing gasoline prices were up a lot. Food prices up 0.2. Food at home up 0.3. So still a little bit of inflation at the grocery store. Motor vehicle insurance down 0.4. That was one that was rising big. So it looks like we've seen a kind of a rollover in inflation. Airline fares up just 2.7%. They were up 5.9% in the month of August. So inflation has rolled over, at least in the month of September, and this is good news for those who want a Fed rate cut.
Mike, I feel like we're out of practice. It's been so long. Mike McKee, thank you, sir. Some economic data to go through. Yields take another leg lower at the front end of the curve. We're down by 5, another leg higher in the equity market. You can see that across the board down the S&P, on the NASDAQ, on the Russell. We turn briefly to foreign exchange as well. Just a little hint of dollar weakness and some euro strength. Data out of Europe was pretty good as well this morning. Eurozone PMIs, one of the best reads we've seen going back to 2024. Look out for the US PMIs a little bit later on this morning. If you are just joining us, a downside surprise on headline and core CPI, unlocking some lower bond yields this morning, going into that Federal Reserve decision next Wednesday. Joining us now to discuss is Tiffany Wilding of PIMCO. Tiffany, welcome to the program. Is this a source of comfort for this Federal Reserve next week?
Well, I mean, I don't know. I mean, I think certainly it's good news on the inflationary pressures, but the argument that we've been making, which I think is symptomatic of this report, is that the economic adjustment that we're seeing to tariffs is coming through less on a price adjustment, and instead companies are finding ways to defend margins by offsetting other costs. And I think the fact that you saw another headline this morning around a large retailer, that is doing, some layoffs at the, kind of higher executive levels, that's just in our minds symptomatic of that they are finding these other ways to cut costs. So, what that means for the Federal Reserve is that there is some downside risk to the labor market here. So I don't know that they should be, completely, taking a sigh of relief here. We need to see the labor market data, obviously, when the government reopens. But as you and Mike mentioned, we do think they cut in October. And of course, the median expectation from
That's
the
so
Fed is to
obvious.
kind of get into
Why would they
December.
release data that would be
What level
bad
of
for them?
weakness at
They
the
would
equity
only release
market
data that would
conference?
be
When
good for
Chairman
them.
Powell goes into the news conference,
They
what
don't
does
have
he
any
usually
reason to.
say?
They don't
More than
have to.
anything right now, how much guidance
I
can we
mean,
take for December and beyond?
Yeah, I mean, I think it's incredibly tricky, and I'm not sure that they will offer a lot of guidance. I think they're going to say that we don't have a lot of data to go on here. There's private sources of data, but even there, it appears that some of the Fed's, the previous sources of private data that they got in the labor market, maybe they're not getting anymore. So it is a much more tricky situation for the Fed. They're going to be looking at markets and and I think the news flow in order to kind of figure out what's going on here. And I think it's going to be really tough for him in terms of guiding any further. Tiffany, a lot of people have been looking at the housing market in particular as a sign of disinflation going forward. And one thing that Mike pointed to was owner's equivalent rent. Looking at this, it just looks like inflation owner's equivalent rent has fallen to the lowest pace going back to 2021 with a pretty big decline, which is one thing that's giving fuel to some of the enthusiasm in bond markets this morning. I'm just wondering how big of a tell that is for you.
Yeah, no, I mean, I think the normalization in housing and rents is something that the economics community has expected for some time, and I would argue that it's delayed, and it was delayed because we saw a really big immigration boom over the last couple of years. Now, obviously, that the immigration policy has taken a big U-turn, you're not seeing those tailwinds of additional population coming into the United States needing housing. And as a result of that, you're seeing rents cool off quite a bit. So I don't think it's that surprising, but I do think it's one of the things that should give the Federal Reserve comfort, that they
I didn't
the
think
inflationary
3%
pressures
inflation was what we
outside
were
of
looking
some
for. I
tariff
mean,
related pass-throughs
looking
are
like
pretty benign at this
2%.
point.
I mean,
Given the fact that
is
we're seeing no inflationary pressures to note that really are even beyond what people expected, and you are getting these announcements. You were talking about the Target announcements without naming them, laying off about 1,000 people and removing 800 jobs from their listings. We also saw GM announcing a round of job cuts this morning. I'm just wondering how much these are just anecdotes and typical versus something that really is a softening that is behind the disinflation as well as the
yeah,
concern
it's
about
typical to lay off your
affordability.
workers in mass bunches.
Yeah,
Yeah,
I mean,
real
we
typical.
think it's very symptomatic of how we see the economy that's ultimately adjusting to tariffs. I think the really big surprise this year coming into the year and thinking about tariffs is that you'd get some price level adjustment. And there's multiple ways that companies can adjust to this. And I think what we're learning is that they're not fully adjusting prices, and that they're trying to offset costs in other ways. And I think the fact that you're seeing this AI investment boom and some broadening out just in the diffusion of AI technology, companies are hoping to get some labor saving cost benefits here. And investing in capital because of the new tax law, the One Big Beautiful Bill Act, gives you pretty big, tax incentives with upfront capital expensing. So I think companies are really just making this adjustment, more so through the labor market. And in terms of the Federal Reserve and their mandate, that just suggests that they have more room to start to adjust policy back towards neutral. If they do cut 2 more times this year, they would be, 3.5, which is kind of the upper end of the range of neutral estimates that they have. And so getting back there and making that adjustment, seems very reasonable to us, just given the information that's coming in.
Tiffany, when you say labor saving cost benefits, should we all be expecting more layoffs then to be announced in 2026?
Well, I mean, I think the economy will need to go through an adjustment as a result of these transitions that we're seeing, whether it be the policy related transitions this year or this tech. Sort of tech transition that we're seeing. It does seem like AI is moving pretty quickly. I think it's still uncertain how much productivity gains we'll actually get, and how that will save costs for companies. But I think we are starting to see the effects of that. I think you can start to see it at announcements, layoff announcements as well at some of the tech companies. It is displacing some workers. Now, I think what's harder to understand is, eventually it will also create new jobs, and how quickly will that happen, and what those new jobs will be is more difficult to forecast. But I think at least in the near term, you will see some labor saving, displacement here, and the companies need that, and are forced to try to get it, because they have more tariff related costs.
Tiffany, thank you. Tiffany Welding there of PIMCO. It's why so many on the committee right now are prioritising the one side of the mandate. To take stock of things, though, unemployment in the low 4s, headline inflation still at 3%. There's a lot of people out there still asking the same question. There's some hawks on the committee. They'll say the same thing. What's the rush? Why go again?
And the Fed's still going to cut rates, so they can ask questions all that they want. And ultimately, how they justify it is going to be that we are at restrictive areas, so we have some room to have these insurance cuts. You are asking the right question about long term. Can they signal beyond that level, those easy insurance cuts, about how far they can cut into just what a lot of people can't determine is the neutral rate?
It gets harder, that's for sure. Equities roll over just a bit after spiking, still positive by 0.5%. In the bond market, off the back of the right kind of downside surprise on the CPI report, yields are a little bit lower, but off session lows. We're down 3 or 4 basis points now on 2 at 345. Let's give an update on stories worldwide with your Bloomberg brief. Here's Yahara. Hey, Yahara.
Hi, John. President Donald Trump has terminated trade talks with Canada. The president posted on Truth Social this morning. Canada took a big buy ad saying that Ronald Reagan did not like tariffs when actually he loved tariffs for our country. Ontario Premier Doug Ford responding on X, writing, Canada and the U.S. are friends, neighbors, and allies. President Reagan knew that we are stronger together. Meanwhile, this just in, General Motors is laying off more than 200 workers, mostly affecting tech center employees in Warren, Michigan. The cuts come just after GM raised its profit guidance for the year earlier this week. The news also follows a post in the last hour from President Trump, who touted the positive impact of tariffs on the company. Shares are up nearly 1%. And the Trump administration is preparing a proposal to open almost all U.S. coastal waters to new offshore oil drilling, despite opposition from state governors. Sources telling us here at Bloomberg that the draft plan for selling oil leases includes waters near the southeast U.S. that President Trump tried to close off while campaigning for re-election 5 years ago. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. Thanks for this morning. Up next, we'll catch up with David Kelly of JP Morgan Asset Management as we break down the latest CPI data. Plus, Danny's got some morning movers. Beyond Meat, up on a revenue beat. That stock is higher by 11%.
Beyond Meat. Beyond Meat. Oh, man, that was a stock that I just said short. I don't ever want to buy this product ever. And it was shorted heavily. Now it's making a little bit of a squeeze. Making a wee bit of a squeeze. This thing was how high? How high? 250 when it IPO'd? Yeah, that's how you can get fucking rugged as an IPO investor. Invest in some fake meat. But hey, making a rebound. Look at that. 400%. What did this close at? 65 cents? How did it get financing? It must have got some type of... What is this earning? 80 million rev? What did it do over here? 80 million rev?
We have two essential crises, and for both it's now or never: democracy and climate. And they are absolutely interlinked.
Look at this. Tell me how this is not Bloomberg.
To solve them together.
Oh my load. Bloomberg Seattle. Oh my load. It's like somebody's mad. Why would you be mad? Fuck. Do you see rallying here? Probably.
sort of a K-shaped CPI report. The thing that really jumped out at me is, first of all, rental costs coming down. There's, we've got a big change in demographics here, and rental inflation is just going away. You also saw used vehicle prices fall. I thought that was pretty interesting. And then the big thing here is core goods prices outside of food and energy. That's the stuff that should be hit by tariffs. But that's only up 0.2%, up 1.5% year over year. It is clear that mainstream retailers don't believe they can pass on the tariff increases right now, and that's what's making this inflation rate a little bit tamer than people feared.
David, doesn't this just justify what the market's already sussed out, which is that inflation fears were overblown earlier this year? The Fed can keep cutting, potentially below 3% by the end of next year, and that it's not going to cause a huge inflation problem?
Well, I never thought we had a long-term inflation problem, but I think it is still early days on the tariff effects. What's going to happen is, right now, retailers feel like they can't pass on the price increases. But early next year, you're going to have this refund bonanza. The average income tax refund per household, we believe, is going to be over $4,000. Last year was $3,200, and that is the exact time when retailers are going to feel like they can pass on these tariff increases. So I do think we've got a little bit of a spurt in tariff inflation still to come. But then, if nothing else happens, there isn't a lot of momentum in this economy, and it'll slow down again, and it'll cool down again. So I don't think we've got a long-term inflation problem. My real question is, given how bubbly financial markets are, do you really need the Federal Reserve adding more liquidity to the party right now, or should they just hang on in there and say this is enough liquidity?
What are you saying, or what are you seeing that really is bubbly, given the fact that earnings have exceeded expectations, the forecasts have exceeded expectations, and we're likely to see more of the same next week with the tech earnings?
Well, valuations are extremely high for the over. Now, obviously, a lot of it's concentrated in the mega cap stocks, but also profits as a share of GDP are extraordinarily high. So overall, the total value of all U.S. market cap is about 365% of GDP right now. It was about 212% before the tech bubble burst back in 2000. It was 87% before the 87 stock market crash. So there's it's leverage upon leverage, high PE ratios on a very high level of earnings relative to GDP. Now, I still think this is a very good economy for equities, but I wouldn't say that you could call the market depressed at this stage. I think that one of the dangers here is that everybody gets out over their skis, and then you have a significant market correction or a bear market.
So are you talking about potentially, if the Fed is cutting into strength, they'll be making an error this month?
Yeah, because it's a different economy, and we keep on talking about, well, the Fed's going to tighten to lower inflation. Forget about it. The Federal Reserve's short-term interest rates are not impacting growth. They're not impacting inflation, but they are impacting financial markets. And the big problem that we've had in this century of the 2000s hasn't been CPI inflation getting out of hand. It's asset bubbles, whether it's housing bubbles or tech bubbles. And the Federal Reserve should not be in the business of blowing up bubbles. So I think they should just take it easy. I don't mind if they cut rates a little bit here, but I certainly would have a problem if they cut rates below what they think neutral is, if the economy is not threatened by a recession, because we are seeing money go into financial markets, go into financial assets, and just not come out. And it's kind of like a stuck valve. And the more money goes in, the more this market just seems to accelerate upon itself.
David, we asked Governor Waller this question when he was on the programme last week. We asked whether he was getting lulled into cutting interest rates and potentially juicing financial markets. David, do you think there's a problem with their interpretation of the dual mandate, or just the dual mandate?
I think the dual mandate itself. I think that Congress needs to recognize, they need to recognize that monetary policy has significant impacts on financial conditions, and therefore maintaining stable financial conditions should be part of the goal. It's kind of like with the ECB, who for years decided they weren't supposed to intervene if one particular country got into significant economic distress and destabilize the euro system. And then finally Mario Draghi said, look, if Greece is a problem, we got to do something about Greece. Well, this is a similar situation where the mandate needs to be expanded a little to recognize the impact of Fed policy on financial and other asset price bubbles, to try to prevent bubbles or busts, because of course that's what a bubble creates a bust, and you want to have financial market stability, not just economic stability. And I think the Federal Reserve can have an impact on that.
David, this was thoughtful. We appreciate your time. David Kelly there of JP Morgan Asset Management. an important question about the Fed's dual mandate, and I've heard that question now a few times.
Yeah, especially because they seem to respond to financial conditions, but only when markets go down, not when markets go up. And that has been a consistent theme over the past number of years.
It's going to be a really challenging meeting next week, especially because they only have the inflation print. That's it. They're data-dependent Fed. They only have inflation. But more so, what do they do in December if the shutdown is prolonged past today, 24 days?
What a week coming up next week. This week has all been about anticipation of next week. Massive tech earnings, Federal Reserve decision, and a meeting between the two leaders of the two largest economies on the planet, the President of the United States with the Chinese leader Xi Jinping. Coming up on Monday, full coverage of all of that with Elizabeth Economy of the Hoover Institution, Greg Peters of PGIM Fixed Income, Angelo Zeno of CFRA, Abby Yoda of JP Morgan Global Wealth. Before we go, a very special happy birthday to our executive producer, Amy. Have a wonderful birthday, Amy, and to all of you at home, have a wonderful weekend. Live from New York City this morning, good morning.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Isso, ao começo, eu tremia, não sabia o que fazer. Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro
What is this?
Estado.
Some type of Russian, Brazilian kind of documentary or something from Bloomberg. I don't know. But that was pretty crazy there. I think market open is going to be pretty crazy too. So we saw that inflation number come out. People, I mean, we got the bulls on parade over here, and it's kind of, I mean, giving back a little bit of it. And I mean, if it were really dovish, and if it were really kind of hinting at more or lower rates, more cuts, then I mean, 96.59, 96.63. But the rates are kind of giving it back too. We want to see these go higher. Right now we're seeing a neutral rate at about 2.95%, 100 minus 97.05. And interesting, because yeah, definitely liked it off the rip. But moving forward, just kind of thinking about further inflation and kind of how the market already priced in these cuts, and the market already has them priced in, basically telling the Fed what it's going to do. But it's also more of a prediction. I think it's more of a prediction towards Powell getting out, and then we're turning into this uber dovish Fed. But I mean, NASDAQ's certainly reflecting that type of sentiment. But when you look at bonds, I mean, bonds are not doing that. I mean, I had to get out because it just didn't look that good. But yeah, that's where I'm at. Is I mean, you saw gold too. Gold got a little bit of a pop, but isn't back. I mean, not rallying towards back to highs. It looks like. Same with silver. I'd expect silver to be leading the way if we had kind of impetus for more cuts, but we're seeing that maybe we'll get some more. That Z25 contract is huge. You know, December 2025. What will rates look like? I mean, looking like 25 basis points, but I think it's more like 50 basis points between now and then. Can we add SOFR? That'll make things much easier. So this is like the actual overnight financing rate. And then all of these are futures at a futures on the overnight rate. What will that overnight rate average at during that expiration? And that nuance, it matters because it's really like the pricing of funds for everyone. So we've seen, I mean, this go up for the past couple of years, expecting more cuts, a lower neutral rate, lower cost of funds, and well, I mean, yeah, this is kind of like the primary, but oh yeah, you can't get SOFR on here because it would be just the rate. Supported resolution.
Huge surprise in the sense that it was only slightly lower than anticipated. We'll take what we can get. But take a look at the overall numbers. The 3/10 gain in headline and 2/10 gain in core on the month. Better news, and that's something to hold on to. But look where we are annually. There's a 3 handle on core and headline inflation, and that is not a 2 handle, which is what the Fed's target is. So we're not going in the right direction,
I'm
even if we're
saying,
going in
Mike.
the wrong
I'm
direction a
saying.
little bit more slowly. Some of the numbers in specific sectors were a little bit of a surprise too. No surprise that apparel was up 7/10 because that's
I think
obviously
it's that
heavily tied.
rent
Gasoline we knew was
owner's
up
equivalent.
during the month. Here's a surprise: housing up just 1/10. Omar Sharif of Inflation Analytics says that that was a probably noise-related number. It may not have a lot of validity because it was such a big drop in housing prices, owner's equivalent rent. Furniture also tariffed up 0.9%. Here's an interesting one, though. Smartphones down 2.2%, and that may be because Apple held the line on pricing when it brought out its new iPhones this year. So it's something to keep in mind as we go
I also
forward.
think those
And
tariffs,
finally, we
I
did
don't think
note
that's a
that
good sign.
the Social Security cost of living increase for 2026 is going to be 2.8%. That's why they put out this data. During the government shutdown, they had to have the latest numbers to calculate what the COLA would be for next year.
The iPhones remind me of, I'll never forget when a reporter told Ben Bernanke that you can't eat an iPad. By the way, the White House says just now, coming over the wire, there will likely be no release of the inflation data next month, which is interesting. Don't they legally have to put out some release for the COLA increase for Social Security recipients?
It's based on third quarter averages, and so September was the last month of the third quarter. The farther we get into October, the longer it goes, the less time they will have to collect data. We saw this in 2013. A lot of data comes in electronically now, so that would still be available, maybe half or so. But if you're not collecting the rest of the prices, you're not going to get a scientifically valid number. So people have asked me, well, does this mean the Fed's going to cut rates at both October and December? December, who knows? Because they're not going to have any data maybe. And, it's better when when you walk into the dark room, as they say, you want to avoid the furniture.
Well, I think we all hope that this government shutdown is resolved by then. Michael McKee, thanks for joining us, Bloomberg's international policy and economics correspondent. Now, Ford's CEO, Jim Farley, says the production of the company's top-selling F-150 pickup will bounce back after a fire at one of its key aluminum suppliers. I spoke with him yesterday on The Close.
We're still working through it. It'll be, I'd say, around 100,000 units, but we still have the opportunity to improve that. This is really a retiming of wholesale. What we lose this year, we'll gain most of it back next year. Maybe $1.5 billion to $2.5 billion of EBIT this year, a little bit heavier on the cash because of how auto works. But we'll be gaining at least $1 billion, if not more, of that back next year.
For more on Ford, we're joined by Bloomberg's auto reporter Keith Naughton. He covers the company out of Detroit. And Keith, You know, this was interesting yesterday. The market has known about the Novellus fire for a while now, and I guess the shares rallied on a little bit of relief that Ford is going to boost production to try and bring some of that back, but it's still going to cost the company quite a bit.
Oh, for sure. But there was relief, Matt, because they feared it would be far worse. The loss will be about 100,000 units. The financial loss will be 1.5 to 2 billion of EBIT. But as you just had Jim Farley saying, they think they can make a lot of that back. And the other thing that sort of counterbalanced and helped drive the stock up is that they had a very strong third quarter. It was a big beat, and they're selling a lot of very profit-rich SUVs and pickup trucks.
What about this message from the president on Truth Social, Keith? He said Ford and General Motors up big on tariffs placed on big and mid-sized trucks coming from other countries. Is that why Ford and GM are up big, Keith?
Well, I mean, Jim Farley did thank the president in his comments to the analysts on the phone, and his CFO, Sherry House, said that the tariff impact will be reduced by $1 billion based on these newest tariffs and the proclamation from October 17th that extended tariff breaks for automakers to 2030. So they did get relief on tariffs, and both GM and Ford reduced their tariff impact numbers this week.
All right, Keith, thank you very much. That's Bloomberg's Keith Naughton in Detroit. And we're going to have more from Matt's conversation with the Ford CEO in the next hour. First, other earnings that hit the market post-market close yesterday. Intel, those shares climbing 5.8%. Their sales forecast was below Wall Street estimates, but that's because some analysts were still including revenue from a unit that Intel just spun off. Bloomberg Tech co-host Ed Ludlow joins us from San Francisco. Ed, digging through Intel's results, how much of it is starting to factor in the various partnerships and investments they have from the government, from OpenAI, from SoftBank, versus just like a classic PC kind of market for them?
Yeah, the plan in the short term was to strengthen the balance sheet, and they probably added $15 billion in that sense in the quarter. They also paid off $4 billion of debt. The one partnership that isn't accounted for yet is the NVIDIA investment. That $5 billion stake or investment will close at the end of the current period. But basically, the stock is up, Danny, because in aggregate, the turnaround, they are producing evidence that it's working to an extent, at least based on financial metrics. But the environment for them was a lot better than perhaps they had thought. PC processors is still their bread and butter, and Windows had a refresh, AI PC is strong, they benefited from that. But they're also finding a little bit of a foothold in data centers and servers, noting that they don't do the sexy bit. They don't do the GPU that NVIDIA does. But their argument is that the hyperscalers and other data center operators realize that the CPU is ready for a refresh, and so they're investing, and Intel's a beneficiary of that.
Hey, at my weekly dad lunch, the topic of conversation has been whether or not ChatGPT will be a monopoly. And I see you wrote a story yesterday with a couple of your colleagues, Davey Alba and Rachel Metz, about Alphabet working with Anthropic. What's the deal?
Yeah, I mean, Anthropic is a frontier model lab, an AI lab that has just intense demand for compute. This confirmed our reporting from earlier in the week, right? But 1 trillion TPUs, 1 million TPUs, 1 million of Google's custom processors is a massive win and validation of their custom technology for both running models, inference, and training them with Anthropic, who historically have been very closely aligned with Amazon. And so, that was a very interesting dynamic to play out this week. It's not been a very good week for Amazon and AWS, frankly. So the fact that Google's willing to back Anthropic at that level with the compute they need would suggest, to answer your question on ChatGPT, that Claude, the models that Anthropic makes, are seen as market leading and a contender. But I would say that the difference between ChatGPT and OpenAI and Anthropic went very aggressively and early for enterprise business, not for the consumer. And now OpenAI is kind of acknowledging that they need to catch up in that enterprise domain.
If it were OpenAI, then it could be 1 trillion TPUs.
I know, and I misspoke, sorry.
No.
Yeah.
I mean, in this day and age, I wouldn't initially or immediately disbelieve that number. Ed Ludlow is the co-anchor of Bloomberg Tech. That show kicks off at 11 o'clock, a show you don't want to miss, even on a Friday. Let's get a check on futures, because on this Friday, we're looking at a rally to what could be another record close. Right now, S&P futures up 0.6%, NASDAQ futures up almost 1%, about 0.9%. So we could see new records on both of those benchmark indexes.
Thank you, CPI. Now look at some of the other movers that are on our radar this morning. Deckers, which makes Uggs and Hoka's, is plunging. 2026 sales look weaker than anticipated. Analysts say it might be a conservative outlook. I don't know if the issue is the consumer. The CFO got on the earnings call and said that people are worried about tariffs and higher prices, so they're not buying. Or is it just that nobody wants Uggs anymore?
Well, I certainly don't, but
I'd be surprised if you did.
Tastes change, so maybe, I will by this Christmas. P&G sales, Procter & Gamble sales, topped estimates led by beauty and razor products. P&G maintained its outlook for the fiscal year, and as a result, those shares are up 2.5% in an up market.
Yeah, and it just shows that people are willing to pay up for brand names like P&G, so not everything is weak for the consumer. We also heard from precious metals miner Newmont. Their 2026 guidance for gold production is the same as 2025, which disappointed analysts and shareholders, especially given the run that gold has been in. Shares down 5.5%.
All right, coming up, President Trump halts trade talks with Canada over a tariff, an anti-tariff ad. Plus, he heads to Asia for a high-stakes meeting with China's president. We'll round it all up for you next. This is Bloomberg Open Interest.
Yeah, this is going to be a huge week. Huge week. And, I mean, not for nothing. HV is flashing, and this little tool right here, this HV optimized kind of in a way, is also very low. So, I mean, we could see a nuke. We could see a nuke of epic proportions here in the form of trade deal with China, even if it's even if it just any type of headline that could come out that says trade deal with China, anything, doesn't matter. It's like same thing as headline earnings. Be whatever. That could be the impetus for a incredible rally, incredible, and anything like that. If if it's more than that, then I mean you could see this expected move look like gospel, look really like the truth. And I mean you could see, and there's not for nothing. I mean we started the month. This was your center line 25.6. And then the optimization, I mean, it says actually 26,150 for the center line, and then you look up and at the top line, 27,000. 27,000. That's 2,000 points away, and I mean, I think that you could even see a nuke to 28,000, which would be a fucking that would be that would be an incredible rally. So if we see that, then you could see, I mean, and you see how Tesla's kind of hanging in there. I mean, even with their abysmal numbers, that and when I say numbers, I say earnings. I mean, I think that they're. I mean, I have this dope chart right here, and it actually works well when it during earnings. And then if you go to FA, maybe FA copies where it's at. Yeah, FA copy. FA copy. What Tesla needs is like, yeah, like I mean, if you open up China, if you open up China to the West, I mean, and even in just a muted, even in just like a any type of form, I think that's what Beijing needs. I think that's exact. Well, I mean, that's obviously what they need is capitalism come in and save them. I mean, at least in the short term. But yeah, big week. And if that doesn't happen, and if things get worse, then you could see that nuke.
Firms now command a fifth
Downside
of global trading revenue and could hit 30% by the decade's end, according to Boston Consulting Group. Fueled by tech and lighter regulation, they're overtaking banks like JP Morgan and Goldman Sachs as top market makers, and Jane Street alone raking in $10 billion last quarter. JP Morgan Chase plans to let institutional clients use Bitcoin and Ether as loan collateral by year-end, deepening Wall Street's crypto embrace. The program will rely on a third-party custodian and expands the bank's acceptance of crypto ETFs as collateral. The move is a symbolic shift for CEO Jamie Dimon, once a fierce Bitcoin critic, as major banks warm to digital assets under the Trump administration's lighter regulatory stance.
See, that was him just fucking covering his bag until now he can use it as collateral at his institution for leverage.
From former President Ronald Reagan's address in 1987. Here's part of it.
Throughout the world, there's a growing realization that the way to prosperity for all nations is rejecting protectionist legislation and promoting fair and free competition. America's jobs and growth are at stake.
President Trump, reacting on Truth Social, wrote, quote, Canada is trying to illegally influence the United States Supreme Court in one of the most important rulings in the history of our country. And he even said that President Reagan loved tariffs, which makes me think I wasn't there in the 80s. Let's bring in Brendan Murray, who leads our global trade coverage. Brendan, I was there in the 80s. And President Trump, although he did put tariffs on some countries and industries, was most definitely anti-protectionism and pro-free trade.
Yeah, absolutely. I think what President Trump has done with this tantrum that he's thrown against the Ontario government is turn a lot of people to President Reagan's old speeches about how free trade is really the path to prosperity, not tariffs. And so this could complicate the talks that are going to start in the weeks and months ahead between the U.S. and Canada and Mexico. They need to review the USMCA by the middle of next year. And so this really isn't a great starting point for those negotiations to get going. But by the same token, the president of the U.S. didn't threaten tariffs. He just threatened to suspend talks. So there seems to be some room for Canada to either apologize or retreat in some way to get back in President Trump's good graces. But it definitely leaves the two sides in a sticky situation if they're going to reach some sort of agreement on the USMCA negotiation by the middle of next year.
At the very least, it shows that negotiations and talks and sentiment can turn on a dime. Brendan, we're also awaiting a meeting between President Xi and Trump next week at the end of this month. What's the expectation?
Yeah, well, first we're going to see Treasury Secretary Scott Bessent meet with his Chinese counterpart in